Well, here to navigate us through this maze are our two expert guides, Philip and Mark. Now, Philip, the floor is yours.
Right. Well, thanks very much, James. I was going to say I'm really talking about the sort of state of play, the economic state of play in the UK this year, and there are sort of property aspects of this which do kind of quiz me on afterwards in the Q&A. But I'm sort of taking a bigger picture look at to begin with. So you can think of macroeconomists as sort of modern soothsayers. They look into the economic entrails to forecast the future, and fortunately with about as much accuracy often. And next week it's the turn of the Office for Budget Responsibility to look into those entrails. And it'll produce its latest predictions at the budget. Now the forecasting business is really about balancing risks. Mervyn King, the former governor of the Bank of England, used to ask me and my economic journalist colleagues that the only prediction he would ever get right is that his prediction would be wrong. He hated the false accuracy of point forecasts, so much so that he actually designed the bank's forecasts around a fan chart of outcomes. And the bank never used to say the UK will grow 2% this year and 1.7% next year. The only way my journalist colleagues and I could ever work out what the bank's actual forecasts were was by using a pencil and a ruler and literally drawing out intersecting lines on the bank's documents to find out where exactly it was thinking that the economy was going very specifically. Now I say this because what matters now are the risks, and for once the risks are to the upside, as economists like to say. Now that is assuming that the vaccines work. So that's a nice position to be after the year that we've had. 2/3 of Britain's economy is based on household consumption. In aggregate, households have never had it so good. By the time the economy has opened up properly, households will have tucked away as much as 375 billion more in savings than in a normal year. Now, this figure came from Jan Vlieger a couple of days ago. He's one of the Bank of England's 9 rate setters. Now, this chart from the bank explains what has happened. Household incomes took a dip when the crisis hit, but they steadied quickly afterwards, and they've risen considerably since before the pandemic. For the year as a whole, aggregate wages rose 1.7% in the country. Now that, if you want a comparison, if you go back to 2012, there was no recession in 2012, certainly not the worst recession in 300 years. So 2012 was worse for wage growth than last year. And of course, in 2009, when we did have the financial crisis and the recession that followed, wages did shrink. So household spending, on the other side of the coin here, has obviously cratered as the economy was shut down. So the last time we spent as little as we did in the second quarter of 2012, well, in the second quarter of last year, was early in 2012. So despite the growth in the population, the growth in the reduction in the value of money through inflation, so the more amount of money that's generally spent, and the growth in the economy, we were spending the same amount as 8 years ago. For the whole of 2020, so not just the second quarter, the lowest point, the whole of 2020, spending was back at 2015 levels. So we basically lost 5 years worth of spending. So as a result, by November last year, £125 billion worth of excess savings had been built up. And that's in this, you can see that in this chart here. These are from the Bank of England. So 125 billion by November last year. Andy Haldane, the Bank of England's chief economist, reckons 250 billion by June. Jan Vlieger says that could be as high as 375 billion. I mean, these are enormous numbers. But the bank is conservatively estimating that only 5% of those increased savings will be spent. The rest will be used to pay off debt or invested in stock market or property. Andy Haldane, the bank's chief economist, doesn't quite agree with his colleagues. He's the boosterist. He's the Boris boosterist one at the bank. He thinks that as much as a quarter of these excess savings could be spent. And that would give the economy 50 billion plus, maybe 3% of GDP boost, which would be a huge stimulus. And that's without the government doing anything. Olivier, now, Jan Vlieger and Jonathan Haskell were actually on the Treasury Select Committee. They were talking to MPs yesterday. They think that the savings will be quite sticky. And the Labour Party has done some analysis of, so they'll be quite sticky. And again, they don't think as much will be spent as Andy Haldane. And the Labour Party has done some analysis of the Bank of England data, and that shows that 1 in 5 households have actually had to draw down their savings to get through the crisis, compared with 1 in 10 households who've had this big increase. So there's huge imbalances in this savings ratio, which does raise questions about how much of it will be spent. Now, the US has also seen an increase in excess savings, and Olivier Blanchard, who's the former IMF chief economist, he has said that as much as half of the excess savings could be spent. Now, however much is spent, the UK government is clear that this pent-up spending, this could create this roaring 20s moment, as we all try to enjoy ourselves once again. That's going to be the starter motor for the economic engine. And when the car gets going, what needs to come in behind it? That's the starter engine, and to get the car moving permanently, we need business investment coming in behind the household spending. I mean, there's good news here too. Companies in aggregate are in very good shape. This chart shows figures from the Office of National Statistics on corporate, private, non-financial profitability. So the ONS, alongside the GDP data, produces an income estimate. So they have 3 measures of GDP, and they're all supposed to come to the same. There's the output, the expenditure, and the income estimate. So on the income estimate, they have an extrapolation of the profitability of the private sector. And aggregate annual profits at the end of last year were 1% higher than they were at the end of 2019. So companies took a bath, as you can see in the chart, in the first 6 months of the year, but they had more than recovered all of that by the end. So again, by comparison, in 2009, in the recession, profits were down 3% by the end of the year. That's what you probably would have expected. And there's been examples back in 2001 in the dot-com crash, where again profits were down heavily. So we've had a remarkable year for the deepest recession, in 3 centuries, and yet profitability has held up and household spending has held up. And not only that, companies have built up 118 billion pound cash buffer. This is Resolution Foundation analysis. In the previous 4 recessions, households drew down 40 billion pounds on average each time. This recession, not households, sorry, companies. This recession, businesses have increased their cash buffers by treble that amount that they previously had run down their cash by. And now a lot of this is to do with the cheap loans that the government has provided, but debt has not. Corporate debt has not got out of control. It's not anywhere close to where it was back in 2000 and in the financial crisis era. So corporate debt is in a very strong, sustainable position. So business profits were not only protected by the 59 billion pounds of furlough, there was 16 billion pounds of grants, as well as tax cuts, tax deferrals, VAT deferrals and VAT cuts, business rate cuts. But they've also reduced their spending. So this is again how they protected their profitability. So investment, unfortunately, so this goes to this point about getting the motor really going sustainably for the economy. So investment fell by 9.4% last year, business investment, which was almost as deep a crash as in the financial crisis when it fell by 13.2%. So in other words, the risks are to the upside, because households are more than capable of starting the engine by going shopping, and businesses are in a good position to keep the engine of the economy going by investing behind that household spend. But on top of that, the government is spending £32 billion more than expected in the March budget of 2020. In March 2020, they had a projection for how much they were going to spend this year, to 2021-22, and they're already on course to spend 32 billion more than was expected just a year ago for this year. So so there's this kind of stimulus coming in already, and that is largely on virus-related measures. But what matters here is that there is more spending going into the economy. That on top of that, we're expecting to see next week Rishi Sunak is going to announce further measures on furlough, business rates, holidays, VAT cuts for affected industries. There's these targeted VAT cuts. There's also stamp duty holiday is going to be extended for a few months. So there's a further 20 billion plus of stimulus on top of an existing 30 billion pound stimulus above what was projected for the coming year just 12 months ago. So you've got a lot of you've got a lot of spend coming into the economy. Now that ought to drive growth particularly well, but there are risks. For the first time in a long time, investors are worrying about inflation. Now this quote from the Bank of England, it's a rather technical quote. This is explaining what the markets are worried about. Spare capacity in the economy is eliminated as activity picks up during 2021. So basically, if you think about the crisis as punching a hole in the economic bedrock, you have to fill that hole up to get back to economic capacity. So then you're back at your capacity growth rate. And once that hole is filled, everything extra, so every bit of growth which is excessive to the growth to the level of growth which is considered, or is your natural level of growth, everything above that becomes inflationary. And markets now believe that with all this household spending and with all this business investment potential there, and with the government stimulus, that there will be a lot of this extra. And so this is driving these inflationary concerns, and obviously the markets are responding with pushing up interest rates, market interest rates, market borrowing costs. So it's not just the UK. The US, in the US, President Biden's got a 1.9 trillion stimulus bill, which takes the total US package to 6 trillion. This is raising concerns too. Larry Elliott and Olivier Blanchard have, not Larry Elliott, sorry, Larry Summers, former US Treasury Secretary, enormously well-respected economist, who's most famous recently for sort of describing the last 10 years as the return of as a period where we're just going to have persistently weak growth, and that's what he's been projecting for the future as well. So now he's worrying that Biden's program is too much, and him, Blanchard, and now the markets too believe that inflation will soon be on the march. So everywhere, market borrowing costs have started to rise. And in the UK, which has gone from COVID pariah to sort of vaccine paragon in all of this, they have risen fastest of all. Part of this is basically the economy has picked up, so you would expect confidence to be recovering, and as confidence recovers, you would see interest rates rising. But part of it is also these resurgent inflationary fears. Again, this is actually a good problem to have. We've spent a decade trying to get some inflation. We had 435 billion pounds worth of QE before the extra 450 billion pounds since the coronavirus crisis struck, and there'd been, across the world, trillions of QE, Japan, US, the ECB, and inflation just seemed to be impossible to generate. But finally, with 375 billion potentially of excess household savings, 120 billion pound corporate cash pile, 50 billion-ish state stimulus in the UK, and the banks too. They've churned out close to 100 billion pounds worth of loans, which are largely taxpayer backed. We might finally have worked out how to generate some inflation. Now we just have to make sure that growth that is being created here is lasting. And the biggest problem is, as ever, or has been certainly for the last decade, is productivity. So once the pandemic is past, the economic impacts of the pandemic have largely passed, the productivity puzzle remains. Philip Hammond was not famous for his optimism. He was spreadsheet Phil or fiscal Phil. He had a reputation as a bit of a dour chancellor. But actually, the economics pack, when we would go to the IMF in Washington, we'd take the chancellor and his aides out for dinner, and he was quite a jokey chap in private, and he insisted on in some of the speeches, which got some financiers laughing anyway. He would insist on writing his own jokes, and I mean, I always thought he was more entertaining than he was given credit for. But one of his arguments that could have been a joke, but wasn't, was that the UK's productivity puzzle was a great British opportunity. So you see, we have so much room for improvement, he used to say, when compared with everyone else. And this chart shows that. The last decade, annual productivity growth has been just 0.5%, which is worse than every single G7 nation bar Italy. And if Philip Hammond was only right, and it worked like a golf handicap that somehow gave us a head start, unfortunately, he isn't. And fixing the productivity puzzle will be key. There's the long-standing issues such as investment, but actually coronavirus may have had an impact here by forcing digital adoption, improving management practices. So it may have given us a productivity jolt. That remains to be seen. But management has been, this long tail of companies with those sort of stagnant management practices has been blamed as the cause, according to some analysis, of part of the productivity problem in this country. So the forced sharpening up of management practices and digital adoption may have actually been quite useful. So that's the sort of internal growth job. If we don't get productivity growth, everything is redistributional in this country. If we want to fix the NHS, if we want to do more universal credit, you have to take money away from someone else. Without productivity growth, it is just about reallocating the pie. So we need to get this fixed, and that's the problem that has to be addressed here. And that's our internal domestic growth issue, growth generation. So as well as looking to ourselves, the government is also looking abroad for growth potential. We're planning to join the CPTPP. This is a comprehensive free trade agreement between 11 Pacific nations that account for 13% of global GDP. The countries are all marked here in blue. Japan and Canada are the biggest. We've got the Singapore and Malaysia, Australia, New Zealand. The UK, of course, is on the other side of the world, which seems like a rather odd trading bloc to join. But the big goal here is to increase services exports. 54% of UK exports are goods, and only 46% are services, yet 80% of the economy is services orientated. Now, a critical part of the deal, if they do let us join from the Atlantic, is about data. There is an innovative digital chapter to the trade agreement that Britain has just signed with Japan, which goes well beyond the EU agreement that it has with Japan, that we've obviously left. So the Japan agreement we signed has been classified as a rollover agreement. It actually is more innovative than that. And the key part of it, the bit that the government sort of is most enthusiastic about, is this open data stuff. And the CPTPP, this big regional grouping, which is after the EU single market, is the most sophisticated trading sort of big trading bloc in the world, and it is, I think it's the second biggest if you exclude this sort of very unintegrated Chinese trading bloc called the RCEP or something like that. So the big one of the big things in this agreement, in the CPTPP agreement, is there is much more harmonization of standards and mutual recognition of standards. So it allows more services trade, and to help that services trade take effect, the transfer of data is key. Now, this is not only for e-commerce, small businesses. If you have much more fluid transfer of data, small businesses are able to do more e-commerce with these countries. It reduces the hassles considerably, and also the just general services. There's a book by economist called Richard Baldwin, which was a big hit in the economic circles a few years ago, and he was just saying that the future of global trade is going to be in services, and it's going to be digitally enabled services. So it's everything from accounting standards being recognized in Mexico or China, and those services being provided by UK providers digitally, to psychotherapy services, to to architects, law professional services. So what's happening here is we're hoping clearly to replace something like the 4% of GDP that was lost by leaving the EU single market with a sort of expansion in our services trade, and so the CPTPP is quite big, and quite a big important deal here. And part of that is also that Joe Biden was a big fan of the TPP before the US left, and they expanded or they rebranded it. The remaining members rebranded it. The US pulled out when Trump became president. It's not clear whether Biden's got the political bedrock to be able to join yet, but he's got a Made in America program, which is basically to put American manufacturers first. If he can get the political support, it looks like he would want to get back into the CPTPP. This would make this would basically, we're obviously thinking forward here as Britain, because then that would be our US trade agreement. We would be negotiating with the US from within a big trading bloc, and it would give us a much better standing from which to negotiate a deal. That would be as deep as just a single bilateral deal, but it would give us this services element that we desperately want with America, because we're already a net exporter of services to the US, and we want to do more of that. So I mean, to sort of start summing up, COVID and Brexit have left scars, and Brexit may have knocked 4% off GDP in the long term, according to the bank estimates. Another thing is that COVID may have caused 1.3 million workers to have packed their bags and gone home. This research by the Economic Statistics Centre of Excellence suggests that much of this exodus has been from London, and this will weigh on growth potential. The big question is whether these foreign workers will return when the coronavirus pandemic recedes. The city is another area where there's concern. The worst case scenario with the city is that it loses 10% of its business. 3/4 of what the city does has got nothing to do with the European Union, and the remaining 25%. There's an excellent think tank called New Financial. They estimated that only we would potentially lose just 10% of the overall trade. So only less than half of our business with the European Union will be lost. Now, there's been Andrew Bailey, the governor, was talking about a sort of escalation of tensions with Brussels just yesterday over derivatives trading. There's going to be some skirmishes, but for the EU to take more than 10% of the UK's business it would require some kind of global change some dramatic change in their sort of regulatory behavior that would basically piss off the Americans as much as it has us. That I just can't. I find it hard to believe that they're gonna go this route where they demand a localization. So all euro denominated transactions have to happen in the eurozone. That will cause all sorts of ancillary problems, if political, diplomatic, God knows what, but other economic problems if they try and go that way from the way people talk about it. So the city is already trying to innovate. We're doing renminbi bonds, green bonds. We have this link up with the Chinese stock exchange. There's fintech is being pioneered. We've got digital currency, central bank digital currency underway. There's all sorts of innovations. The city's being great at innovation. So I think my personal take is that city's going to be fine. It'll still be one of the big hubs in the world. So overall, we've got catch-up growth. We have this prospect of overheating, warning of inflation, higher interest rates. We have the old challenge of productivity, a new opportunity of greater services exports. And the pound surge back above $1.40 suggests that there is underlying confidence in the country from abroad. Now, we haven't exactly had a good crisis, but we don't emerge from the wreckage in traction. Markets end up judging country sustainability as much by their relative position as by their absolute position. And net debt will be around 100% of GDP clearly for several years to come. And now that's up from 80% before the pandemic. But the UK will still be better, as this chart from the ABR shows, than Japan, Italy, France, and the US in the G7, which is exactly where we were before. So nothing changes really. And so challenges and opportunities ahead. I'm personally an optimist. I think that the biggest risk is inflation, and I think I subscribe to the Roaring Twenties scenario where we start to get back to normality pretty quickly by 2022. There will be some changes, and some of those changes will be in the property sector. But I'll hand over now. Thank you very much.
Well, thank you, Philip. What an amazing sweep across a number of pointers here for where we're heading. So that the Roaring Twenties perhaps is innovation in the city. Digitally enabled services is a way for international growth. Now, that provides a really good setting for me now to introduce and hand over to Mark Long. Mark, I think the floor is now yours to respond.
Thanks, James and Philip, and it's great, Philip, to hear that you're even more positive about the prospects of the UK than I am. And I thought I was in a minority there compared to a number of property forecasters. And I'll just take 10-15 minutes of your time to run through where we see the property economics and some of the strategies we think where there's value going forwards. So I'll just briefly talk about Orchard Street. James has given an introduction. We're a relatively small firm. We've got a number of clients across international and domestic, and we run money across the spectrum from diversified funds all the way up to sort of liability matching long income, and we're really proud of our track record that we've delivered over the 17 years that we've been going. So if we just jump into the economics and financial bit, if there's one slide I wanted to show you, this would be the one. And here we've got the orange line is the 10-year gilt yield. And that's the yield is on the right-hand scale. The blue line is property yields, and the grey shaded area is the yield premium which property is delivering. And what you can see here is that property is now delivering a higher yield premium than any time in its history. So relatively, property is looking underpriced versus gilts. And we've seen as gilts have come down quite sharply, and this is what's been driving the performance of the gilt market over for a number of decades now. And looking forward, we really like property. One of the fundamental bedrocks of that is because the income delivers in an environment where you can't get income anywhere else. And we think this is one of the fundamental reasons why money is going to be drawn into the market. And long term, this relationship's been sort of 200 to 300 basis points of yield premium from property versus gilts. When it drops below that, as we see here in 2007, that's when the warning signs are that property is overpriced. When it's above that, we think that's a good sign for property is looking like good value now going forwards. I think as Philip showed this chart, we saw on the left-hand side, we've got the GDP growth, we've got a massive impact from COVID in 2020. What's less publicised is on the right-hand side here, retail sales, which in part because people weren't going on holiday and so weren't spending their money. We had a big drop in spending as the lockdown hit, but spending actually recovered to above the level it was at pre-COVID very rapidly and grew from there. And it's part of the relentless rise. Retail sales continue to rise long term, for a long period of time, and it's proving to be incredibly resilient. So we see lots of headlines, negative headlines about the retail sector as a whole, but actually, people aren't spending less money; they're spending more money, and they continue to spend more money. It's just where they're spending it, which is changing, and I'll come on to some of those points later on. Looking at performance now, this is UK property in context versus UK equities and bonds. What we've seen, as I said from the first chart, bonds have done really well, and it's all about yield compression. But where's the performance going to go going forward? Actually, at the end of the year, I think it was 0.3 was a yield on bonds, 10-year bonds, and now it's I think 0.7. So already we've seen some pretty negative returns from the bond market this year. But property long term has actually outperformed both of those. So we've got a high yield premium, and we've had good level of performance long term from these markets, outperforming both equities and bonds over that 10-year period. So we're actually it's an asset market which hasn't, despite the press headlines, hasn't delivered the underperformance which people might think it has. A word about the UK market. Now the UK has traditionally been the most open and liquid and very much so transparent and open to foreign investors. Of all, possibly of all the global markets, often the first port of call for any investor globally who wants to invest outside their domestic market, they often come to London. And part of that is the legal system and the transparency and everything you get from that market. But what happened was when we had the vote to leave the EU, transaction activity has reduced. So uncertainty, has made people sit on the sidelines and not put more money into London. So before that referendum, the UK market was sort of 3 times, so the UK market accounted for the activity of the next 3 biggest countries in Europe. But since then, actually, it's running par and par with Germany. Now we think Brexit is behind us. Once the economy starts to pick up again, once COVID is behind us, that's going to pick up again. So not only are we going to have more money coming in because yields are high and people need income, we're going to have more money coming in from foreign investors who are going to be looking to invest in the UK market for the reasons I've said before, back to the same kind of level we've seen in the past. Another reason for more international capital coming to the UK is that actually the UK has got cheaper in relative terms compared to other markets. And this is prime office yields in the UK, which is actually the West End, versus France and Germany. And what we've seen is in 2016, we've seen yields flatline since the referendum, whereas investment in those French and German markets has compressed yields to an extent that they're now sub 3% versus 3.75% in the West End. And we think this yield differential is going to be another factor drawing more capital into the UK and helping performance going forward. Now, if you remember back to the first slide, one of the first slides I showed you, we've got a high level of income on property, and actually property is all about income. Long term, 70 to 80% of your returns comes from income. And this chart shows it very vividly, over the last 10, 20, and 30 years. It's all about income. So when you've got more income relative to other assets in the market, surely this is an asset class which is going to do well going forward. And this is another reason why people need to invest in income in property at the current time, I think. And this is a factor which underpins returns going forward. What you're buying into is an asset class which delivers high income, and most of the return comes from income. COVID-19, I'll just briefly touch on a few points here. I think there's been a bit in the press recently about this. How do we disaggregate the impact of Brexit from COVID-19? because we're going to get a resurgence in activity once the vaccines and the lockdown is over. We will see some changes in how the economy operates, and we've already seen some frictions in terms of trade in other markets, and Philip touched on a number of financial services which are having more difficulty where activity is moving and adjusting to the new reality. We do think that the economy is going to be adversely impacted by Brexit. Whether we'll be able to disaggregate that from COVID, I'm not sure. The COVID recovery. The impact is likely to be more localized on London, because by and large the UK economy is a domestic economy. It's a big, diversified economy. The majority of activity actually is, in the UK is generated for the UK and by the UK as a whole, rather than internationally. And longer term, we think London will remain the financial centre of Europe and a global financial centre, because it just is so much bigger than any other centre across Europe. It seems inconceivable that that role could move away to Frankfurt or Amsterdam or even Paris. But there's question marks. There's question marks there about will global companies want to have their HQ outside of the EU and that's in the UK, and what's going to happen inside the Eurozone now the UK has left, and there's structural imbalances there, as I think Philip mentioned, in terms of government debt and productivity on some of the southern European nations. So there's pluses and minuses there for activity, I think, going forward in the long term. But it's all about how the government handles the exit now and delivers the productivity growth that we're looking for, as Philip mentioned. So just delving into the property market, I thought I'd just touch on a few of the main sectors and just to talk about some of the issues there. And there's been a fair bit of press about the death of the office, with everyone working from home and everything else. And I just find it hard to believe that that's true. We've had waves of structural change, of technological change, which have done away with thousands, tens of thousands of roles. We used to have every director used to have a secretary, but now it's like 1 between 10. Used to be thousands of people employed in open outcry trading for equity markets, but now it's all done by computers. But despite those facts, there are still tens of thousands more people employed in the main financial centres across the world, not just London. So I think COVID will have an accelerating effect on that, and I think there'll be more investment in technology, and certainly some of the growth markets in London have been not in the main banks, which have actually been losing employees for decades now, but actually in the alternative financial institutions and in the fintech space, the people who are enabling the banks to become more efficient by making all those back office roles automated. We do think that there's going to be a reduction in demand for offices this year and probably next, and that London will bear the brunt of that probably in the short term. But we think longer term, there's a structural change happening in the market. I think going forward, I think that the main impact is going to be that the back office locations are going to be suffering because those jobs are being done away with by technology. So what we're going to see is an increasing concentration of demand into the bigger office centres, into offices which are head offices, which are people call them centres of collaboration and excellence, where your team meet to deliver the best productivity you can. So I mean that it's not, people don't want to work in Wolverhampton or Cardiff. They want to come to a vibrant city location and learn from people, and they can't do that working from home. You can't build your career working from your parents' bedroom in your parents' house. You have to be in the centre of things. You have to build up a network of contacts. You have to learn from and be beside people who've done it before, so you can actually do that. And I think that's what's going to drive office market going forward. It will be, as it has been before, increasingly about the war for talent. Getting the brightest people into your company, having an office that is part of the image of your company, really. And it's the office is not about a factory for producing output. It's about a place where you can attract the best talent, you can attract and get your customers, and deliver the best results for your business. And so we really think that there's a strong future for places like London, Manchester, Edinburgh, Bristol, and also places where there's specialisms like technology, which is more sort of Cambridge Cambridge and Oxford, and maybe Brighton, places where people want to work because of the nice environment, and maybe there's a specialism in terms of business located there. Industrial sector, well, for the first sort of 10, 20 years of my career, people were knocking down industrial estates and putting retail parks and residential there. But internet logistics has changed that and reversed that quite dramatically. And what we're seeing now is that in some parts of the market, rather than being the lowest value land use, it's now the highest value land use of anything. So the demand for this is exponentially grown really over time, and rents have grown and yields have compressed as well. We think there's still some performance to come here in terms of rental growth, but there are areas I think where affordability is becoming stretched, and the occupiers in that market can be particularly vulnerable to an economic downturn, because they don't tend to be, many of them don't tend to be large financial companies with backing. So I mean, one area we love is the multi-let industrial and last mile logistics, and that has to be in and around the major urban centres, and that's where you've got the most limited space, and that's where the interlogistics and people servicing that population, they can operate from most efficiently. Less so the decentralised industrial estates, which maybe were built up in the north and Scotland to try and generate employment, and there's still an oversupply in some of those locations. They're not in the right location, but for doing what they need to do. I need to talk about the retail sector, because as I said, one of my first charts, retail spending is increasing. People are spending more money, and they will spend more money. Just where they're choosing to spend it is changing and has changed. And there's a lot of negative press about this, but if you notice that most of the negative press, as shown in this chart, is all about the high street. And what we've seen is, back in the 80s, there were 200 high streets which were regarded as blue chip prime town centres, which institutions would have loved to hold. Today, maybe there's 40, maybe it's 20 even. What's happened instead is that demand has polarised and spending is polarising in between convenience, I want it now, or it's just a menial job like food shopping, and maybe your destination leisure spend, which is more about spending the day to having lunch with your friends, meeting up, trying on some clothes and looking in the shops and stuff. And there's a leisure experience rather than a menial job you want to get done quickly. So so you wouldn't notice if you read the press that a number of headlines have been actually really, really positive, and especially through COVID. There's a number of especially retail park operators who have had really good COVID, and in the years before have also been performing quite well. If we look at some of the figures for footfall and for car count, town centres have been decimated by COVID, whereas retail parks have seen relatively little decline in numbers. So we firmly believe that there are areas of the market which offer value, and I think the retail park market is one. And one of the reasons for this is that yields have blown out across the retail sector as people have tried struggled to divest, and no one wants to buy the market. But there are occupiers here in this market who are doing really well. They're making profits. The sales are going up, and it's a format which works really well with the changing retail environment, both for convenience, because these tend to be large car parks that are free. They're on major road networks, and it works with click and collect. And click and collect is something which retailers want to encourage more and more. And a large part of internet retailing now is click and collect, and it's far more profitable for companies to have somebody come to your store rather than having to take it to them. And I think it was Curry's PC World who reported that I think it's over a third, maybe even half their sales are click and collect. And when those customers come in, more than a third of them spend more money in the shop on things that they hadn't expected to buy, and that's, I think, £36 was the average secondary spend. So spending that they hadn't thought they'd had. So it is really much more profitable than having to send these out in white vans for these retailers. In terms of the alternative sector, I don't want to dwell too much on this. This is sort of a mixed bag of things, which they tend to be long lease RPI. And this is how the operators and owners of these properties attracted capital into the market, because you weren't able to have a diversified market where you could see how much it was worth because other people were buying and selling them. But here you go, 25-year lease with RPI, that's really attractive, I'll have that. Now there's been quite a big disconnect in this market over the last, since COVID, and there's been much more focus on the operators, I think, and the underlying businesses, and also on what's the rent on that property, and if it was vacant today, if the tenant did a CVA and wanted to leave, is there somebody else who would take it at that rent, or what is the rent? How much do you need to spend on it? I think there's opportunities in this market where you've got sustainable businesses, where pricing has moved out a little bit in some of these sectors, and I'll come on to look at that a bit later, but not hugely. And where those are good locations, good hotels, good operators, then I think there's some short opportunity there for the yields to come back in again and prices to rise. But there's other parts of the market, say perhaps cinemas, where yields are blown out, where the operators are massively over leveraged, and there's a sort of existential threat, question mark about their business models going forward, given that financial structure. So we're a bit more cautious on alternatives, but we do think there's some value in the market there as well. And in my brief, James wanted me to talk a little bit about where yields are. This is CBRE's prime yield sheet from I think it's December. And what we've seen is that some parts of the market yields haven't moved at all. The London city offices, prime London offices, long let to good covenants, absolutely stable. Haven't seen anything move out at all. Whereas the retail sector has generally seen yields move up by at least 100 basis points. And you might want to look at shopping centres there. Even the prime centres have moved up by 100 basis points. And secondary, 14.5% yield on a secondary shopping centre. People just don't know what they're worth because the costs of running these things, when structural vacancy is high, is just so difficult because you have to spend money on to attract every year to attract the customers. You have then vacant rates on top of you've got vacancy within the centre. You also have vacant service charge you've got to pay. So every shop that closes down is a negative impact on your net income. So it's really difficult to tell. And even retail warehouse markets have moved out quite a lot. But I think there's some real opportunity down that market because it's more sustainable and works better with the current retail environment. I think I'll touch on responsible investment. I think this is one of the keys that we think is the key to the future, because increasingly companies are saying, look, we're not going to occupy an inefficient building. We're not going to occupy a building which isn't offering our staff a good environment which to deliver the best result they can. Here's something which we built. We've just built down the road from Heathrow. It's a speculative redevelopment of a nasty old industrial building. It really did look like that beforehand, the top picture. And what we've done is we built a fantastic, 4 or 5 units. They're carbon zero in operation. And the first unit we let just a week before completion. The directors of the company turned up in 5 Teslas. They took a look at the PV on the roof, the big Tesla battery inside, and the car charging points outside, and said, "We'll take it." And those kind of companies are out there, and they're looking, and they're very selective. And and it's not just about reducing carbon and everything else. It's all about lowering occupation costs, making it good for the tenants, making it a more profitable and viable location for them to do business. And just lastly, on just looking at the office market, and I've talked about how I think offices are, do have a future going forward after a bit of short-term volatility. But I think the type of office you're going to be looking at in the future is going to be different to the office that many of the offices that are there in the market today. It's no more sort of battery chicken factory offices where you're trying to squeeze more and more bodies in. It's much more about creating the right environment for your staff. And this is a building we redeveloped a couple of years ago now. And what we've done is it's the first refurbishment, I think, which is well accredited, which focuses more on the wellness of the building and the facilities it offers, cycle storage points, outside space, what the materials you put in there, and circulation space and that sort of thing. I think increasingly it's going to be, it's not going to be squeezing more people into the buildings. You're going to actually have more space per person to enable the interaction, to have the workers actually, wanting to go to the office to interact with their colleagues and delivering the best result. And I think this is a step along the way to where we're going to go in 10 and 20 years time. So I think this is the start of the future of the offices, rather than your great big, maybe your great big towers where you're squeezing in thousands of desks. So I think that's more or less the end of it. There's a few words from our compliance team. Yeah, and overall, I think it's great to hear Philip's words on positivity on the market, even more positive than we are. I do think that there's a real opportunity in the property sector going forward, and it's underpinned by current income. Yeah, and if we get some stronger economic growth than we forecast, then there'll be some rental growth as well. Thanks. I'll hand over to James.
Well, thank you, Mark. That's another fascinating presentation. In fact, we had two very positive presentations, so that's really sort of encouraged me. And actually, we have a range of questions which have actually arrived. So I'd like very much to invite both Philip and Mark back on, if they could switch their screens on. We can kick off with some questions. Thank you. So right, I think the first question, which is this is actually aimed at Philip, and I think this is inspired by Elon Musk's recent investments. So the question is that given the anticipated long-term strengthening of cryptocurrencies and unpredictable volatility around sterling, dollar, euro, will Bitcoin and other cryptocurrencies become preferred currency for international trading and business? And if so, how soon?
All right. Can everyone hear me?
Yes, we can hear. Yeah.
So I think what's happening in Bitcoin and the crypto market is it's becoming a store of value. I think that's what Bitcoin is becoming. I don't think it's a transactional. Not a transactional tool. It's too volatile to be a safe transactional tool. If you want to use it, if you want to use crypto for or these digital coins for transactions, there's stable coins like Libra or DM now, which is better for that kind of stuff. I think what we're seeing is well, the fact that Elon Musk can move the Bitcoin price by a quarter just by a couple of random tweets just shows you it's out of control. But I think what is genuinely happening is there's a lot of mainstream institutional money coming into Bitcoin now. It's actually part of this inflation story that I mentioned. There and QE, the vast amounts of quantitative easing that's been done internationally, the fact that central banks are able to sort of effectively what some people fear is debasing currencies, and so the fact that Bitcoin has a finite capacity of 21 million coins, that gives it the same kind of potential stability of value in an inflationary environment as gold. So if you think about Bitcoin as a digital form of gold, you just can't put it into your jewelry. That's how I think about it. I don't think it's going to be changing transactional stuff and trading stuff. I think there's stable coins, and I think central bank digital currencies, which we may have within a decade. Those will be the places to look for the transactional, the side of currency stuff. Okay, well,
thank you, Philip. And I think allied to that question, perhaps I'll just orientate this towards Mark, actually. And that is that, well, certainly a year or so ago, there was a big sort of talk in the UK markets at blockchain becoming sort of relevant. I mean, obviously this started off with fintech. I mean, is blockchain something that you feel is actually going to sweep through the property industry to help with transactions management and so on, or do you think that's a sideline?
I mean, technology is undoubtedly changing the way we operate and the way we work. We're not quite at blockchain yet, but we're fundamentally changing how we do business processes. Yeah, I mean, our reporting now is all automated through a fantastic workflow process tool called Aldrick. So, but we're sort of baby steps, and we're not, we're only a small company. So, some of the bigger companies I know, there's quite huge efforts and huge amounts of money being spent on and where it will deliver benefits, people will invest in it. think that's the key. And is it going to be blockchain or is it going to be something else? I don't know.
Okay, thank you. Was there anything you wanted to add there, Philip? I guess it's...
Yeah, I mean, blockchain is what this distributed ledger technology it makes. Creates these kind of smart contracts, so everybody can be paid at the same time. It removes a lot of bureaucracy from payment structures. It creates loads of visibility. I mean, I've seen it in the music industry. You know, artists create all of their amazing songs, and they're the last ones to get paid. And so, you know, if you think about, I don't know how it necessarily would work in the property industry, but you basically when a payment goes, when the core payment goes out, it just gets distributed to everybody visibly at the same time, stripping out loads of intermediary costs. I mean, if we can use the technology for that kind of smart contract stuff, that I'm sure it's welcome in every industry.
Yeah. Okay. Great. Thank you. So the questions are coming in thick and fast. Another one for you, Philip. Under Biden, are we at the front of the queue?
Oh God, I think, yeah, I think we are. I mean, where are you? I mean, the EU are also talking to the US. I think there'll be much more. It'll be much easier to do a deal with the UK than with the EU. I genuinely think that the way in will be the CPTPP. If we negotiate just us bilaterally with the US, we will not get a good deal. If we do it through the CPTPP, we're part of a trading bloc, and the trading bloc, including, you know, Japan, Canada, others who've already got deals with America, that it'll just, we go in there with more leverage, and some of the things that America are going to ask for, like, I don't know, chlorinated chicken or whatever, we will we'll be able to resist more easily from within that trading bloc, because it's never going to be as ambitious as if we just do a bilateral deal. That's the other thing. It's never going to be quite that kind of massive US-UK trade deal, which, you know, could be equivalent to the EU single market that we've left. So yeah, I'd say we were close to the front. But look at the CPTPP stuff. I think that's if Biden signs up to that, starts signing up to that, talking positively about that in the next year or two, that would probably be the way.
Okay, great, thank you. And so another question initially coming your way, Philip, and perhaps Mark could give a view. What is your view on the possible renaissance in manufacturing in the UK? Can we still rely on services and technology skills only if this doesn't happen?
Yeah, well, I suppose two things here. I mean, I'm not sure if there is a renaissance in engineering in the UK, but I think the green revolution, yeah, the green industry stuff, which, you know, the government is putting money into. They want us to have a much bigger domestic wind manufacturing and engineering expertise. We've basically been we're the biggest user of wind in the world, for relatively speaking, but we basically get the Danes to make it all, as far as I can tell. So we want to do a lot more of that. There's this new technology called carbon capture and storage. There's been money being put into that. Hydrogen as well, hydrogen energy. There's all these new things which will require manufacturing and engineering skills and expertise, and the government wants us to become like a front runner in the world on all this. It's an ambition. I can't actually, I don't know if it's going to be achieved or not, but I mean, it's good that it's an ambition. And with sort of in terms of regional stuff, I think that the move to remote working will allow services to migrate out of the cities. I mean, Mark was talking about some of the back office stuff can be done from home. So I guess that's secondary cities, but I think that this increasingly, you know, the secondary cities will be able to make an offering for some of the services work that's done in the UK that they struggle to at the moment. because people don't necessarily want to live in really expensive city centres and don't want to have a 2-hour commute. And so, but now in future they will be able to manage that. So I think that's reasonably positive for the regional story.
Yeah. Okay. Was there anything you felt you could add from a property perspective, Mark?
Yeah, and it's difficult to see. We've had decades of integration into a free trade area, how that when you leave that area and you create some frictions, that it can result in a renaissance. And I think the car manufacturing industry is a good example. Swindon, Honda are moving out post. I think the EU did a deal with them with Japan on normal cars, not luxury cars. I think so. And you have to be the most productive, to make that work. On the flip side, maybe that's going to be good for warehousing. Maybe COVID's good for warehousing as well. So we've seen a lot of log jams at ports and disruption in supply chains. So maybe we need to do some more reshoring of our production rather than having it the cheapest location where you're vulnerable to these kind of lockdowns and trade issues. So there is that potential offsetting impact, I think. But it has to be led by technology. It has to be led by the kind of industries which the UK excels at, and it's not been really engineering. It's been services. Yeah.
Okay. Yeah. Thank you, Mark. Now, I think another question coming your way, Mark, actually, which is linked to carbon zero, and in effect, clearly, it seems to me that this is a sort of a trend which is going to the ESG agenda and move towards net carbon zero is moving forwards. On a property level, I mean, to what extent do you see this impacting on rent levels and void periods and so forth? This is a question which has been put forward by a few people.
Yeah, I mean, we're wrestling with the impact of this. There's probably a small premium for a better building, and tenants, I think, aren't being educated enough, aren't thinking about the total occupation costs when they're looking at buildings. They're thinking about it looks nice, it's the right place, it's a 5-minute drive from home and that sort of thing. There's regulation is the government is clamping down on inefficient properties, and you're not allowed to let anything with an EPC G and F, I think. So within the whole stock of property in the UK, there's an inherent capital spending liability there, which I think is not sufficiently quantified at the moment. We've started going through our portfolio, and we're looking at assets, and we will take a knackered old 60s industrial shed and make it a lovely, overclad it and insulate it and put some PV on the roof, and and the rent will go from £5 to £6 because it's a better unit. But is that enough to justify the capex that you got to spend to get there? So it's a massive issue, I think, for the market. And in certain locations, I think it does work. I mean, where you've got industrial is a great example there. We've got knackered old 70s sheds where you might get 50p more for having a brand new building, because the demand is just so high that all the properties rents have been bid up. So you can't actually justify doing that capital expenditure. You actually make a loss by making it carbon neutral or upgrading it at all. And one of the ways around it we've done is we put solar PV on the roof, and we sell the electricity to the tenant. So you're paying your rent or a higher rent for a better building, but you're also then buying electricity from us for 10 or 20% less than you buy it from the grid. So there's one way of offsetting those costs, I think, and there's some other ways of doing it as well. But the capex time bomb, if you want to call it that, inherent within the whole UK market is underestimated, I think, at the moment.
Yeah, well, thank you, Mark. Yeah, so I think it's the one underlying theme there that hasn't been expressed until now, and that is obsolescence. I guess that this dramatic structural change which is ahead of us is great, but of course there's the underlying obsolescence factor. Now, unfortunately, I think we are now effectively coming to the end of the Q&A session. There are many other questions which people sort of would like to have answered, and I think we'll try and deal with those after the webinar. And so it's well, it's now time to thank Philip and Mark, and afraid I have to draw what has been, I think, a very insightful and enlightening webinar to a close. And let me close with what's, for me, are some key takeaway points. Philip has set the broad backdrop for the starting motive for growth, but with risks on the upside. And interesting to hear sort of views on inflation coming back at a time when overall growth is still going to be a struggle. And huge imbalances, though, in savings, but at the same time, lots of dry powder out there to be spent. Now, Mark has reminded us that despite a year of turmoil, properties remain the best performing asset class over the longer term. And we've heard all about structural change, and that the zero carbon footprint and the ESG agenda is something we need to take on board. So now, on behalf of everyone at Matthews and Goodman, and everyone out there in webinar land, I would like to say a big thank you to both Philip and Mark for their honesty and for their sharing of their, well, there's no other word for it, their wisdom with us. We can now return to our home or even real office, and we'll be sending you some slides for you to review later to become better informed, better equipped to make recommendations and take decisions. Thank you, gentlemen, and thank you to everyone out there on the other side of my screen. Take care and stay safe. Thank you.